Welcome everyone to the Directed IRA webinar and a Directed IRA special podcast episode 2. Thanks for being with us. I'm so excited for today's topic and that I have an amazing guest in studio, Veena Jetti.
Hi.
Thank you for being here.
Thank you for having me. I'm excited about this.
I am too, you know. I'm excited to hear what you have to say. Everybody doesn't really care what I got to say today. This is but we're going to get into it. We're going to get into multifamily. This is kind of Veena's lane. You told me don't ask questions outside multifamily.
Yeah, I don't know anything else.
Yeah,
I know about one thing. I have one trick.
It's just like regular value outside of this. In multifamily, it's like exponential
value. Exactly. I mean, I don't even know if I'd say regular value outside of this. I know enough to be dangerous on many other topics.
Okay.
So
all right. Well,
don't listen to me about those things.
Well, I tend to stay in my lane too with self-directed IRAs, but this is a really big topic. I mean, multifamily has been a significantly growing asset class for IRAs. We have a lot of people who invest their IRAs in small partnerships, syndications, big funds, little funds, doing some form of multifamily. Yeah. So we're going to talk about that today, see where the market's at. Why don't you give some people your background, though?
Yeah.
I was going to say it, but
You want me to say it? You want me to do the work?
Yeah, I want you to talk. Yeah.
Well, I'm Veena Jetti. I founded a company called Vive Funds. We're large multifamily owner-operators. We operate primarily in Texas, Florida, Georgia, North Carolina, South Carolina, and Arizona. We're closing on a deal here in like a month and a half, which I'm really excited about. I think this market's a phenomenal market. Okay. I've transacted on... After July, first week of July, it'll be just over $1 billion in real estate.
Okay. All right. I knew you were at the 900 million mark.
I was at 900 million. Okay. This is going to tip me over the $1 billion.
All right. So are you going to be in the next season of Billions?
I think so.
Yeah? You and Bobby Axelrod?
I mean, that's going to be the
plan.
You
should have like a guest appearance on it, I think.
I should, obviously.
Yeah. Did you watch the show?
No, I didn't.
Okay. Well, you're rolling with it. It was a great show.
I watched one episode, and then I think I got distracted by like another...
Yeah.
Another episode of something else.
It. So, I don't want Veena to understate it, and you know that was a great summary. But like Veena buys like big multifamily deals.
Yeah.
Right. You're just not buying like 10 units.
No, usually not. I mean, I would love to if someone else would do the work, so I don't have to do the work. But no, we don't. We target 200 plus units.
Yeah.
I have a very strong preference to 300 to 400 units and up.
Okay. All right.
So,
so these are big deals. All right. And now you have investors, you've had people invest with IRAs too over the years.
Yes.
Okay. And that's
amazing tool.
Yeah. Awesome tool. You can invest in what you know. Like our tribe here, Directed IRA, they know your IRA is not just stuck on Wall Street.
No, it's not.
You can invest in real estate.
And a lot of people don't know that.
I know. It's we still go to conferences this day. Like even some of my team, my partner was in Hawaii talking about it, and he's like, these are sophisticated people that have done 10 plus real estate deals themselves
and still don't know.
They are like blown away that you could do this.
Yeah, because no one really talks about it.
Yeah, I mean, we're trying.
I mean, no, but there's so much market share that isn't being spoken to now. And so, I know a lot of people from my community are on here, and I totally think that they should be connecting with your team, because as they go out to, because I talk about capital raising a lot.
Yeah.
And as they go out to raise capital, like, there's millions and even billions of dollars that...
Nope. Trillions.
No, stop.
There is trillions.
See, I don't know about these things.
Okay, there is $35 trillion in U.S. retirement accounts. Doesn't that blow your mind?
There's more than 1 trillion?
With a 35 T. We're talking trillions of dollars.
And if you don't know about this, then you're leaving all of that on the table.
And it's cool for like a lot of different people. Like, maybe you have your own little sliver of that 35 trillion and you've been frustrated by Wall Street. You have a mutual fund, you don't even know what the heck it is. You believe more in real estate. Go take control of your IRA or 401k and invest in what you know and what you like, if that happens to be real estate. But also, if you're out raising capital to fund deals, everyone else is out there with this 35 trillion that could be investing in your deals.
Totally.
So,
yeah, it's a secret.
Yeah.
It's a secret sauce.
Yeah. So that's what we're here doing all the time.
How would someone connect with your team?
So just go to directedira.com. You can schedule a new account appointment if you want to open up an account. If you're someone who raises capital on an ongoing basis, we have a business development team that you can send your people to, and then they kind of get a relationship with you and your fund, your subscription documents, and work with your people that are like, hey, I got an IRA and I want to invest. So,
and I have to say, I'm just going to plug you for a minute here because...
Please.
You sit back and relax. No, but I've worked with every IRA company out there,
Yeah.
every single one. And
when you're doing $1 billion in deals, okay.
Yeah, you've worked with a couple, right? And I just love your team and the response and the white glove treatment from you guys. You guys are the only ones that I've received that from. Even people that I've had like relationships with.
Yeah.
At the beginning it's like fine, but it's never more than 1 or 2 emails just to like get the foot in the door. And so I really appreciate that about your team and how you guys have set up your company to be differentiated from all of the other self-directed IRA companies. So thank you.
You're right. And you're welcome.
I'm always right. You can ask my husband. He'll tell you I'm always right.
That's because he wants to be happy. That's what I learned, in marriage is you can be right or you can be happy.
I mean,
you can't.
That's what I tell him too.
Yeah, so, all right.
Okay. Well, now a relationship podcast.
Anyways, okay. Let's get into the topic of the day, though. Multifamily. Tell us where is the multifamily market right now? Like, how would you summarize it? Because in the past few years, it was like, shortage of multifamily, low interest rates, rising rents. I'm like, if you own multifamily, those were like.
Yeah, the
that
best
was
thing
like
ever.
Awesome, right?
Yeah, it was amazing.
What is it now?
So we're definitely moving out of the bull part of the cycle, I would say. A lot of people have seen this default that happened from Arbor in Houston.
Okay.
It was like 3,000 units were foreclosed. And I get sent that article all the time. They're like, oh my gosh, is this going to happen to us?
Yeah.
Which I get, right? And what we're seeing right now is there are a lot of operators, as I like to call them, like real estate tourists. They just came in the last year or two. They dabble in this. They don't really operate full time in this space.
Yeah.
And what happened was when interest rates were at 2.5%, 3.5%, everybody thought they were going to stay low or stable for a relatively longer period of time than they did.
Yeah.
And, in 2021, when we were buying, we were underwriting to an increase on interest rates, which was very unusual at that time. Everybody thought we were totally crazy. And even then, we couldn't predict how sharply they would rise and how quickly it would happen. So we were, more ahead of the curve, and we were still off because, Powell's just going.
Right, yeah.
Going.
It feels like he's cooling his jets now.
Does it?
I don't know.
He still raised it by 1/4 point.
I know, but now the messaging has been, we're not going to raise it. We're assessing whether we're going to raise.
Well, from your mouth to his ears, because
I got him on direct dial. So
if you want me
to relay a message,
I would appreciate
really
it.
Nice for the multifamily market if he's just laid out.
Just he could just do it slower, and it would be okay.
Yeah.
But I think that this is the top of everybody's mind right now is with interest rates where they are, what is happening? And so what we're finding is the deals that are really working and penciling right now are great loan assumption deals.
Ooh, okay.
So our deal here in Arizona, we're assuming debt on that, and it has...
Is that debt locked, though?
For 12 years.
Okay.
7 years of interest only.
Nice, okay.
And it's at a sub-3 interest rate.
Wow. That's like free money right now.
That's what I'm saying. I'm like, I'll just buy all of these all day long, right? And then it's in a fundamental market. It's in the Arcadia area.
Yeah, it's a nice area in Phoenix.
Really nice area, great submarket. And so we're seeing those opportunities emerging. We had another deal that we were trying to lock up. It didn't end up working out, but it was in Myrtle Beach.
Okay.
And that deal also had a 3-point-something interest rate, which is, again, like you said, free money. But these are assumable loans. So that's really the name of the game right now is creative finance and or assuming debt.
Yeah. Okay. So now this is I think a lot of people are familiar with the subject to strategy. We were talking about Pace Morby earlier.
Pace Morby's strategy.
The creative finance wizard.
Yeah, the king of creative.
Yeah. And so he's got the subject to strategy that he teaches quite a bit, which is a great way to acquire real estate without coming out of cash out of pocket. But, I've actually done some loan assumptions on a commercial property. Our law firm's office building in Utah, we bought and we assumed the loan. The current business that was in there was an engineering firm, was in default, and the loan was awesome compared to the market rates. And this was 12 years ago. But we acquired that property and just assumed the loan from the bank. And the bank was like, please give us someone who will pay the rent and actually use the property.
Right.
So,
well, because banks are not in the business of owning real estate.
Yeah.
They don't want to actually own the real estate. They just
Yeah.
want people like you and I who are going to pay the interest and not pay it late.
Yeah, especially at where rates are at right now.
Right.
Yeah, they definitely don't want to own real estate.
Right, yeah. So I would say, I mean, I'm still bullish on multifamily as an asset class in general. You know, people always ask me, they're like, oh, are you buying right now? Yeah, I buy it every single point in the market cycle. What changes is our strategy, right? So our investor return projections are going to change to reflect what the market is, but also our strategy is going to change because now we have to be a lot more conservative than we could be 5 years ago, 8 years ago when, like you said, it was like the heyday of multifamily, right?
Like you could be an idiot and
throw,
make money.
you throw a dart and you'll make money. It was very tough to lose money the last 10 years. Now it's probably a little bit easier.
So where are banks like originating loans for now? Because if you can get something at sub 3, which you're able to get, easier to, you know, obviously that debt service is low. Like where are rates right now? If someone's trying to buy new multifamily,
depending on the borrower, like we're preferred borrowers because of the volume at which we borrow at, but you're probably looking somewhere between 6 and 7 at a minimum, maybe
so
higher.
That's at best if you're preferred.
Yeah, it may be higher, you know, and it prices, it's pegged to SOFR now. So the SOFR rate is really what's going to dictate it. But usually I would say at this moment, most people are going after fixed rate debt. We're not really looking at adjustable debt because it's just too risky at this moment. And the people that are really panicking right now, and rightfully so, are people that have rate caps. And the insurance on the interest rate is expiring this quarter. There's, I think by end of Q2 is 1,457 loans are going to have their rate cap expire by Q2 of this year.
Yeah.
That's going to be a problem.
The banks are going to start moving. They're just going to say, hey, you owe us more money. Start paying us more.
Going to be a problem. And what I think a lot of investors don't realize, and I hear this a lot from investors, they go, oh, I'm just going to wait until the crash. And it's like, well, it's not really going to work like that. And they're like, oh, I'm going to just wait and then buy all of those assets. So I'm keeping all my cash. I'm like, you are never going to see those assets. They are not trading on an open market. They are being traded quietly in the background. I've had dozens of phone calls just in the last few weeks of friends of mine that are operators that are having their rate cap is expiring. They're having this issue of what are we going to do? And they're like, Veena, can you recap us? Can you buy this? Can we do something with this? And I'm like, I can't because there's no equity. There's no GP equity. Otherwise, I could recap you out of this, bring whatever 2, 3, 5 million to the table, and I could recap you out.
What are the banks going to do? Because there's all that's the other on the other side. You hear on the banking side of things that all these community banks that have huge multifamily portfolios, they're they're concentrated in that, and they're going to have to work with these operators, don't you think? Or like, what's?
I would assume so. I would assume that that's going to be what the play is because as cap rates are expanding, the assets are now worth less. So you can't even really re-leverage your debt right now. And interest rates are crazy. So it's already the same problem happening again. There's not enough cash flow to support them. So I don't actually know what is going to happen, but I think that a lot of investors are going to get hurt, which really sucks because, you know, once an investor loses money with anybody, they're not investing again, probably. And so it's hard for all of us when we're raising capital, even good operators that are being good stewards of these funds. So
your strategy right now, like you said, the assumable loans, you're trying to find those deals that you can acquire that still have that low rate. You're doing big deals. I presume the competition is less at the larger deals.
Yes
or it's like
no.
very inefficient operators like insurance companies or something.
Yeah, a lot of insurance companies, a lot of really big operators. What's great for us is we're small enough that we don't have to cross a whole ton of red tape to get an asset under contract. And we don't have these crazy mandates that a lot of the bigger funds have. So we're kind of in that sweet spot of where we're not quite operating like a family office, but we're also not operating like an institutional fund. We're like somewhere in between the two.
Okay.
So,
Okay, let's get into some of the other things about multifamily that's hot right now. And by the way, Veena is going to be at our Alt Assets Summit. That's June 29th and 30th. That's how Veena and I met at Amy Majori's Raising Private Money event back in Long Beach. But so this is June 29th and 30th. I think you're on the agenda for the 30th.
Yes.
Okay.
I'm coming for the 30th.
Yeah, it's going to be a heck of a good time.
I'm excited about it. And I'm going to be like hanging out too. I'm not going to just like speak and then run away. So I'll get to meet you guys too.
Well, even better.
So,
even better.
yes.
You can get a picture with Veena.
Yes.
Right?
Yes. Take a photo with me and tag me so that I don't have to do any work for social media.
Yeah, your social media team will be like, thank you.
They're so happy when I ask people to take a photo with me and tag me because then I have like content for days.
That's what it's all about.
That's
what it's all about.
I mean, do it for the gram, right?
Yeah, it's all for the gram. Well, all right, let's talk about AI. You talked about you're actually utilizing artificial intelligence in your biz. Tell us what you're doing.
So we've been using AI for like 2.5 years now. So for
You're
a long
ahead of
time.
it.
Yeah,
right.
we're I like to think that we're the fastest implementers on the planet. So we started using AI about 2.5 years ago to model out our predictions in a market. So for example, in Phoenix, we know what rent growth is going to be, not just based on where we're guessing, but based on millions of data points, and AI is kind of shaping those numbers for us and helping us fine tune those numbers. And it's self-learning, so we can continuously go back, re-input, readjust, sharpen the pencil, and go back to the underwriting and tweak it every time we get a new data point. So that's one way we're using it. From the business overall, I mean, we've implemented AI in everything that we do, from email responses to output to social media content to blogs, like everything. Anytime we can use AI, we use it. Yeah.
I know some of our marketing team here in the room has used AI. And it's funny, our executive director of marketing was like, yeah, guy's been here 2 days. You turned this in. I was like, wow, this is really good. He's like, yeah, I used our AI on it. You know?
Yeah.
Like, guys, it'll make you look good.
It's the future.
Apparently.
It's the future. There's actually there's a website I really like. It's called Futurepedia.
Okay.
I think it's .ai or .io. It would make sense if it was .ai.
Yeah.
It's Futurepedia, and I go there whenever I want to do something. So like, let's say I want to make a PowerPoint presentation, right? I go there and I type in like PowerPoint, and it'll pull up. It's like a library of all the different AI resources you can use, because there's just so many of them. And then it'll direct you to where you want to go, and it gets updated, I think, every day or every week or something. So it's like a pretty comprehensive list. And so I'll go and I'll type in like PowerPoint, and then it'll give me like design.ai, it'll give me beautiful.ai, like all the different ones that you can use. And then you can go and you can like check them out, look at pricing, stuff like that. So it's useful. Cool.
All right. Now you've built a team over the years as you've been doing multifamily. Like I think you call it a power team.
Yes, my power team. Yes. My power team. You'll be happy to know there's an attorney on my power team. I mean,
Nick?
Yes.
Okay.
Yes. No team is a power team without an attorney.
That's true.
On speed dial.
That's true.
That doesn't bill you for everything that you ask them.
Every 6 minutes is billable. I told Veena, she's like, I can talk forever about this stuff. I'm like, I've been an attorney billing by the hour for over a decade. I can make 1 hour. I can turn that into 4 hours if we need to,
That's what we were talking about when we were on mute in the beginning. So now they know.
Billable hours.
Yeah, billable hours.
Okay, but you pay lawyers a lot, and
yes.
If you're doing multifamily, you're going to have a lawyer on your team.
Probably many lawyers.
Right.
There was probably a time, maybe like 10 years ago, where I'd been like, we pay them way too much. But now I've seen enough and done enough to know that when you pay good lawyers out of the gate, it saves you so much more money later down the road. Yeah. Because litigators are way more expensive than contract lawyers.
Exactly.
So much more.
Yeah, and they're a pain in the ass. And even when you win, you feel like
you still lost. Yeah, you still lose.
Yeah. So I had, it's interesting, because we used to do a little bit of work with people raising capital back in the day. I would do some of that work. And I had two different people that we interacted with here in Phoenix. And I had one client that had just a private fund doing real estate deals. And this was before 2008, and lost a ton of people's money. Well, the State Securities Commission came and started investigating this guy because he had like 20 people go complain, right? And if you lose that many people's money, you're going to get someone from a state or federal securities office on your door.
Someone with a 3-letter agency is going to
with a badge and a gun. Okay. Well, I remember he was freaking out, of course, as he should. But he had all the docs, right? We had his Form D, he had his private placement.
He notified the state,
he had all
the blue sky,
he had his Form U2, he had all that stuff done, and he was like super grateful. Literally like 2 or 3 weeks later was a client calling in who didn't do all that stuff, but went out and raised tons of money from people on unsecured notes.
Oh no, what happened? What? No, don't tell me. It's too painful. What happened?
There was, he got a criminal charge actually, but I do not think he did actual jail time.
Okay.
But he had a securities license, lost the securities license.
No, not anymore.
Yeah, not anymore, and will never in the future. And so, but, had a criminal action brought against him. And so, like, I think some people, when they're raising money, they forget that there's a lot of laws about this. Like, there's the SEC. This is not like the Southeastern Conference for college football.
No, it's not.
This is the Securities Exchange Commission. They can be mean.
They can be mean. And they're there to protect investors. So I actually appreciate that they do regulate because, I invest into things. I want to be protected also.
Yeah.
The challenge, I think, that you have is, especially in raising on like Reg D, which is what we raise under 506B or 506C, right? We do 506C.
You do C, okay.
Only
so only
C.
accredited investors.
Only accredited investors. But the challenge is there's no real big barrier to entry.
Yeah.
So anybody can go out and raise funds.
Yeah.
And so it makes it harder. I almost wish there was like a license to do what we do because I think it would just make it so much better for everybody.
Yeah.
I don't know.
Well, we're going to talk about that at the Alt Asset Summit. We have some due diligence stuff. Actually, your lawyer, Nick's going to be there on one of the panels on due diligence.
Oh,
and so we got a little panel on that. But and I know you've talked about kind of like what questions should you ask a sponsor? So like if you could just talk about that for a second.
Yeah.
Like if someone's an investor and they want to go into someone's multifamily deal, like what should they be asking as an investor?
Yeah. Okay. So the number
What questions
one,
do you hate getting?
I actually don't hate any of them anymore.
Yeah.
Because I've answered all of them now.
Yeah,
When I first started, though, I'd be like, I don't know the answer to that. I'm going to have to ask someone on the team and get back to you, right? Like that was 90% of the questions I answered when I first started. Now it's, I pretty much know the world of our business that we operate in. But what the one biggest mistake I see, and tell me if you agree with this, you might see it. People go out and they go, I'm a capital raiser. And I go, what does that mean? Are you a broker dealer? And they'll go, what's that? And I'm like, okay, you're not a broker dealer because you would know if you were a broker dealer. But here's the thing, the SEC is very strict about broker dealer rules.
Yeah.
That means that I can't tell you, hey, go out and raise me $1 million. Every $1 million you raise, I'm going to give you $10,000 or whatever that number is, right? I can't do that unless you're a broker dealer. I cannot give you transaction-based or success-based compensation.
Right.
What's happened over the years is a lot of people have gone out and said like, oh, I'm raising capital for this deal. And that's their only role.
Yeah.
And their compensation is based on the success of the deal or the success of the transaction. And so the first question I ask somebody, and this is actually kind of a little bit of a trick question.
Okay.
You're going to love it as a lawyer.
Right.
I always ask them, I say, okay, are you a GP? And they'll usually say yes, right? Because they're getting some GP percentage.
Okay.
The question I actually ask them is, can you influence the language that goes into your PPM? Who are all the people that can influence and interact with your securities attorney?
Yeah.
And the reason I ask that question is because only people who are truly general partners on the deal can influence that or interact with a securities attorney.
Yeah.
So I always ask that question because it's an indirect way of finding out what their role is and if they're complying with securities rules.
Yeah.
And it's not, it's not someone that knows like, are you just a capital raiser?
Yeah.
Are you breaking securities rules? Like most people are probably not going to answer that very directly.
Yeah.
So this question, it doesn't put their guard up, but it gets you the information that you need to know, okay, is this truly a sponsor that I'm talking to?
Yeah. And I think that's a big red flag. If the sponsor even itself is letting people go do that improperly to get money and they're paying, sometimes they'll call it a finder's fee. And I know there's a very narrow exception for finder's fees. But if it's performance based, like
hard no.
1% of whatever you bring in, we pay you a fee. Yeah, it's an indication that company who's raising the capital isn't willing to comply with the law.
Or doesn't know.
Or doesn't know.
I don't know
Either
which
one
is worse.
is bad.
Yeah, I don't know which is worse.
Either one, they're not getting my money.
Right, and that's why you want to know when you're talking to someone, is this a capital raiser?
Yeah.
Or is it a true GP? And so you ask them, do you have the ability to negotiate what goes into the PPM or influence the PPM? And if they say yes, Or yes, I'm the one that handles that. Or yes, I do, but with input from this person and this person. Great, you're probably talking to a true general partner on that.
And then sometimes they would be in the docs.
Yeah,
right. Like the executive team,
you
know,
they should be
in the private placement or the in the memorandum, conference memorandum, whatever you call it.
Yeah.
They could be on the website, but if you're not seeing them connected.
That you never really know.
Yeah.
Being on the website, right? And even in the documents, like
it's on the internet.
Yeah. But it feels like.
But the private placement, because those are going on the Form D to the SEC, right? The executive team, they're in the so that would be you'd check the box on that one.
Yes, and so that was actually my second. You stole my thunder.
Oh, well, we're just volleying back and forth.
I'm gonna have to walk away from this conversation. No, that was my second. That was gonna be my second thing. So there's a website, edgar.gov.
Yes.
If you go there, you can look up your Form D for the offering that you're investing into. Okay, but the only thing is if you're a passive investor, don't panic if it's not up there yet, because they have a significant lag. Yeah. It sometimes takes like 4 to 6 weeks for it to get up there. Okay. But you can ask your sponsor, are you filing a Form D? They should say yes, and then they should be telling you where to go and find their names or what the name of the entity is. Or you can, if it's someone that's done multiple deals, like you can see my past Form Ds and know that we file them. Yeah,
and that Form D, we look those up at Directed IRA when someone's investing into a private fund. We go there and look, is this an operator that's done it? We want to know that too. And now sometimes if they're new, like you said, you won't see it. Yeah. Or even if here's another one, if they haven't sold anything yet, they have 15 days until the first sale to file it. But I'm also like, I don't know that you want to be the first investor either. But ask for a copy. That's what we've said is if it's not up there, just say, give us the copy you filed. We might not see it on the website, but let's at least try to get a copy.
Thanks for adding more work for me.
Yeah.
I'm just kidding. No, it's fine. I mean, look, any good sponsor is going to already have it in their world of documents. Yeah, we have copies of.
So this is like the due diligence part. I mean, you're vetting the sponsor. You're looking at their docs. What should you expect, though, in terms of like the deal? Like, have you ever seen like funds structured like really bad for an investor? And how?
I hate to use the word bad, right? Because there are many roads that lead to Rome.
Generous.
Many funds are structured, and
like Stevie Cohen, for example. I don't know, he's got a big private equity fund. Like he has a 5 and 50, asset under management and profit carry percentage.
Okay. Generous.
Yeah, I mean,
to the sponsor.
He's like wizard. And
for those that don't know, 2 and 20 is pretty standard in the PE world.
He's got
so 5 and 50 is
so he's taking a 5% management fee and 50% of the profits.
Look, I think that the thing is if you're taking 5 and 50, but you're going to get me more money.
Yeah, the deal better be good.
Then you get paid, and I get paid, and I'm good with that. So I don't actually care that much about sponsor compensation as a passive investor. Yeah. That's not where I really focus. What I really focus on is, okay, where's my downside protection?
Yeah.
Right? How are you protecting me as an investor on the downside? I also like to ask sponsors, are you co-invested? Do you get a special share class that other investors can't have? Does your money get paid back first? How does that work, right? Like, so
good question.
We co-invest with all of our investors on every deal we do. And usually my co-sponsor and I, we're the largest single investor into our deals.
Yeah.
Like, there's nobody that invests more money as like a single investor than both of us, our families. And
that's good. You're in it together.
Yeah, basically. We're in it together, and we're in it heavy. Like a lot of times we'll represent above 10% of the capital. That's awesome. Which is really unheard of. Usually it's like 1 to 2% is acceptable in this world. So we're usually more than 10%. Wow. Because we believe in our deals.
Yeah.
And we only invest alongside our investor share classes. So we don't get some kind of special treatment. If anything, we get probably like worse treatment, quite frankly, because if things are going sideways, we're going to be the first to take a step back or take a subordinate position for our investors.
Okay. All right. What else should people ask? I mean, we talked some of the documents. I love hitting the SEC Edgar search. Trying to figure out if they got, unlicensed people, kind of people violating laws to raise the capital.
Yeah. And the reason I like that question too is also because if you're willing to cut corners here on something that's like so big, where else are you going to cut corners?
Totally, yeah.
Right? Like what else are you going to do that's not?
Yeah. That's just like a threshold test of should I do business with this person?
Exactly. And if they're like, what is a Form D? That's a problem.
Right, yeah.
You can also ask about like blue sky, right? Blue sky laws, because a lot of sponsors will be like, oh, no, we don't need to do that. Our attorney said we don't need to do that. That's not true. They do need to do that.
And I'll say this, it's funny because I operate as kind of like the final compliance person if we have to go like choose someone out or reject a deal or something here, which I do every once in a while, and sometimes I get a kick out of it. Yeah. But I mean, I love this because I'll have people be like, well, our lawyer said we didn't have to do that. No. I'm like, get your lawyer on the phone.
Right now,
I want to talk to him. Yeah. They do not have a lawyer.
They don't,
They're pretending like they do.
Yes.
Because that works 9 out of 10 times with an investor.
Yeah, because they're not lawyers themselves or
they
knowledgeable.
Don't know.
Yeah.
And they're putting their trust in this person. They got sold to the idea.
Yeah.
And then their money's sitting over here and they're wanting us to release it. And I'm like, no.
No. I'm glad you do that because that actually really protects investors a lot.
Yeah. And we want, people make their own mind up here. And if someone says, hey,
I don't care. I'm doing it anyway.
I'm going anyways. We have an additional thing you can sign and say to do that. And so, but I think on the investor side, and for the accounts here, everybody's self-directed. You decide what you want to invest into. Like even if you invest with Veena, I don't freaking know or endorse that.
Yeah.
But ask all these questions she's saying you should ask any sponsor.
And that should be for anybody, whether it's multifamily or not. You can ask these questions because if they're raising capital, chances are they are selling a security that they need to have some kind of exemption to rely on.
Yeah.
And this is not legal advice because I am not a lawyer, in fact. So
like, we're going to do disclaimers
I'll leave
now.
that to you. Yeah.
Make up your own decisions. We're not financial advisors.
This we're not tax.
Tax advisors.
We're not tax advisors. We have no licenses to give you any kind of advice.
Yeah.
At least I don't.
Today's webinar cannot be used without the express written consent of Mat Sorensen Inc. or Major League Baseball.
Done.
Okay. All right.
I'm surprised you didn't start with the disclaimers being an
I
attorney.
Usually do, actually. I just got excited, and you were hurrying me up and rushing me to start.
I wasn't I?
You were like, hey, we got to start.
Early bird gets the worm.
It's because, Veena does multifamily, and people got to pay their rent on time. There's a late fee if you're not on time. We don't charge late fees for people late on the webinar.
We should start. There's a new income stream.
It's not a bad idea.
I mean.
Okay. We talked about, I asked about questions to ask your sponsor, but what other due diligence best practices would you say? Is there anything else on due diligence you want to talk about?
I think that these are like the major ones that I hit when I'm asking, but the one big question that I ask sponsors when I'm planning on investing with them is, tell me about the worst deal you ever did. What went wrong? Because what I want to hear them tell me that something has gone wrong in their past.
Yeah.
Because if they haven't had a deal go wrong yet, either they have not been in business long enough, or they're lying. And I don't like either of those things. So I want to know, what is the worst thing that's happened on a deal that you didn't expect? And I want to know that they're going to say, like, A went wrong, but we did B to fix it, and C is what we've learned to mitigate it going forward. Yeah. That's what I want to hear as the response.
That's a great question.
And so if someone's like, oh, we've never had anything go wrong, they maybe never lost money, which is fine.
Yeah.
But they've never had anything go wrong. Something goes wrong by like noon every day for me, right? Like, this is
you
business.
have that many deals going on. There's stuff's going to go sideways. Something's going to get missed. You're going to have a mistake, but you fix it. You deal with it.
Right. And then I also like to ask, too, about what is, after I invest with you, right? Like, once I give you my money, what is the experience going to be like after that?
Yeah.
And are you going to send me an update,
like
once a quarter?
Got my money,
Exactly. And, I tell people, for us, we do a monthly update on the property. Okay. And we'll tell you everything that's happening, like, generally in the asset. And then every quarter we send financials. We send, we're gluttons for punishment, so we distribute on a monthly basis, which is really tough. It's really hard, and honestly, I wish we had done quarterly back in the beginning, but now our investors are just used to it, so I can't go back anymore.
95% of them aren't even reading them.
They do not open my emails.
But the 5% that are will raise hell.
Yep, that's absolutely true. And so, you want to know what their process, what their system is.
Yeah.
You want to know that they've thought through the world of what happens post-close, right? Because if it's just, we're going to see, it's like, okay, you haven't really thought that this is a business for the next 5 to 7 years or however long your investment horizon is.
Yeah, we did a webinar with Josh. I forget his last name, Josh, but he's going to be the Alt Asset Summit Accountable Equity. But he talked about how in his business he's realized, I have 2 businesses now. I have my real estate and operating business. He does like, you know, resorts and wineries and like hotel stuff. And he's like, and I got my fundraising capital business.
Yeah.
Like, those are two businesses.
They really are.
That have two teams that run them and need to be managed. And so
True.
I want to ask though about, for some people listening, you know, are people that aspire to be a multifamily operator, to raise capital. What if from your experience is like, what makes someone be a good multifamily operator versus someone that's going to fail?
Well, I think it's actually synonymous with being a good entrepreneur or business person, right? It's grit, it's perseverance. Look, there are going to be challenges. There just are. If you don't have any challenges, you're missing something very significant that you shouldn't be missing, right?
Yeah,
so
you're not trying hard enough.
Yeah, or you're not trying hard enough. But that's the thing, is there's going to be challenges, and despite what those challenges are, you need to be ready to pivot. You need to be ready to problem solve. You need to build your network, right? Networks are absolutely the single biggest key to scaling in any business, not just multifamily, but especially in this world. Yeah. And, you know, we touched a little on my power team, right? And we talked about Nick, who's going to be at the Alt Asset Summit. So Nick is my securities attorney, and, you know, he's my first call. Yeah. And he's somebody that I like to think of him as, you know, a vendor partner. You guys are our vendor partner for IRAs, right? So when I have an investor that is like, I don't really have the cash, but I have all this money in an IRA, I'm like, amazing. Let me connect you to Matt's team. Yeah. And then you guys, you know, do your thing and work your magic on it that I don't have to know about, which I'm grateful for.
Yeah, it's our pleasure.
Right, and then the money comes into our deals, and like that's another partner for us. Our tax strategist, that's another partner for us. But then also all of our LPs, they're all networks, they're all partnerships. My JV partner, she's probably, we've done like $500-600 million of deals together now. And so these partnerships are really what's going to take you to that next level. It's going to get you beyond the 10 units. Yeah. And even passive investors, right? I have a lot of passive investors. They invest passively and they do this. I just had somebody reach out to me maybe like a couple months ago, and she said, I didn't know that I could do this until I passively invested in one of your deals. I saw the returns, and she's like, now I'm syndicating my own deals. I'm like, oh, that makes me so happy. I'm like, you know, the proud mama bear, right? But so that's what I would tell anybody who wants to get into the space is don't hesitate to be on the LP side first. Yeah, you can really learn the world of being an LP. You can learn what you like, what you don't like about sponsors. I
mean, I hate to say that's like being a customer in some ways, but like, you know, even like our employees here, I'd be like, we need to be a customer of our services, you know, and like learn what it is. And like, what does that, points are. Yeah, what does that LP want? Yep. Like, what are they seeking? And how do they want to be communicated to? I mean, that's a big part of the business. There's the real estate side and analyzing, finding, sourcing, being able to do deals. But the fundraising side is really big. But you brought up an interesting point. And we were talking about a mutual contact we have. I just was on her podcast, Kayla Kraft. Yeah. She just talked about, she called it relationship capital. Because I was talking about building and scaling our business. You know, we're at $1.5 billion in assets here. And
that's all?
I know.
So disappointing.
Yeah, we have like 45, like 100 plus employees between both enterprises. We've grown fast and been grateful to just have awesome people. But I was talking about how like tapping my own network and getting people, particularly in key positions, is really important in our success. And she called it relationship capital. She kind of, and I was like, that is really what it is. And I think for any entrepreneur, multifamily, I'm just like echoing your comment here, really hit, is like, I'm realizing how powerful that is. It's like, it takes people to build and scale a business. You don't build a business. You build people, and they will build business for you.
Yes. Having the right team is life-changing. They have to be the right team, otherwise it's way worse to have the wrong team. Yeah. But having the right team is game-changing. You know, we have an investor coordinator, and he makes our world go round. I will tell you, like, he is always thinking of ways to improve investor experience, that now, so much so, and I thought we were pretty good before. We were probably one of the better teams out there. But after bringing him on board, I'm getting texts left and right from investors, from texts they're getting from other people that they've referred to us, saying, thank you so much for introducing me to the Vive team. They are so well organized, and it's been a pleasure investing with them. Yeah. And, you know, that's the feedback I want, because when you are raising capital, the lower the barrier for someone to invest with you, the less friction you have, the better off you are. Yeah. And that's why IRA companies are so maddening usually because their friction points are so ridiculous.
I know.
I've lost hundreds of thousands of dollars because of bad IRA companies in investor money.
I mean, that's our brand promise at Directed IRA is make it easy.
Yes.
Make self-directing easy.
You.
I mean, that's the thing, from like DocuSign to fixing documents when there's a problem, being responsive. It's like the little things.
So much so.
But it's like knowing what you're doing and executing on it's another thing. And I just love that our competitors can't do it. So
yeah, no, I mean, I'm just glad I found you guys because I'm still stuck doing this with other people. And it's tough, you know, especially because we pride ourselves on being kind of like white glove service, right? We call it, I like to say we're the Chanel of multifamily, right? Like we're a little bit fancy, we're a little bougie, but it's that luxury experience. It's that personalized experience, right? And
if you give them Chanel, I get it. I mean, I gave my wife a Chanel purse bag, you know, for her 40th birthday.
And went over well?
Let's just say I nailed it.
I mean, I love it.
She was like, what am I going to do on your 40th? Oh my gosh, you know.
I think maybe watches or man jewelry.
It already passed. We did an awesome trip. But
that's good. Experiences are great also.
I'm actually an experienced guy. I mean, she could have got me Chanel too. But
I mean, then what would you get her for her 41st birthday?
I know.
There's more Chanel to be had, just as a reminder.
All right. So I get the Chanel comment.
So yeah, I want to be the Chanel. But what the challenge is when you have people that you're working with on external teams that you don't control, when they don't have that white glove treatment at in their morals of how they operate their company, it makes it very challenging. And that's what I love about what you guys do is make it easy. And that's exactly what we do too, is we want to make it easy. And we go above and beyond for customer service with our investors. So I'll give you a great example. The other day I had an investor, and this is from a deal that we did a few years ago before you and I met. So it's with an unnamed company that is not yours.
Thank you for clarifying.
Yes, just to be very clear.
Now go talk crap.
Well, our investor reaches out, and you know, every year we have to do the valuation on their position, right? And so they reach out and they go, hey, can you fill all this out? Or I need you to send a form back with the valuation of our position this year. I was like, okay, and this investor is an older investor. And doesn't attach the form. So I'm like, okay. So I'm like, hey, there's no form attached. Can you resend it, right? So he responds back to the email. Again, no form is attached. So I'm like, okay. I know.
From an AOL account?
It might as well have been. It might have been like an MSN account, right?
From AskJeeves.com.
Right, AJ.com. And so and my investor coordinator's on there, and he's, you know, trying to like explain to him how you attach a form. He's like calling him to explain it. And
I know this pain. Keep going.
And so then I finally send an email and I respond back to our investor, and I actually just copied the IRA company on because we have a relationship with one of their representatives, and I copied them and I go, hey, I understand you guys need the valuation form. I don't have it. Can you send it over to me with, you know, the account information pre-filled? We share a mutual client, they're copied here, whatever. Normally, you would expect that they'd be like, yes, because we need this for compliance, we're going to respond back to you and give it to you. It took me like 7 follow-up emails to get this, but we're taking the burden off of the investor. And I'm copying the investor on all this communication. So I'm like, you're just making yourself look bad. This is low-hanging fruit. You can send this to me in less than 10 minutes. I shouldn't have to follow up with you so many times. But it's a great example of why your outside partners, especially your external vendors, are so much more crucial, because like I can't have a performance review with that person. They don't work for me. You know, like I don't have very much recourse other than finding a different relationship that's more aligned with our thesis of how to treat investors.
I mean, you need all those other third parties, those vendors, to make you look good. You know? And like
exactly, and it adds credibility. So for people that want to get into this space, right? When you're saying, "Oh, I work with Matt's team at Directed IRA," well, guess what? Now people are like, "Oh, well, they're legitimate. They're big. They run a good operation. I know other sponsors that have been successful with them," and so now your investors feel more comfortable working with you as a sponsor.
Love that. Great comment. Okay, Tristan, do we have questions? I got my final question for Veena, but I didn't want to hog all the questions. We did say we were going to take some questions. So what do you got, Tristan?
We got quite a few questions rolling in.
Okay.
Veena's team is definitely here. They are active. Hashtag blame Nick was going in there.
Do you know what this is? Blame Nick? Okay, I have to tell this story. Okay, so, you know, and this, you'll understand this as a lawyer. Okay, anytime you have investors that come to you and they're like, oh, this is the worst document I've ever read, because like the PPM is designed to kind of scare you.
Yeah,
right?
it's like let me give you this document. It's gonna be all the reasons why you should not invest with me.
Yeah, and why you're gonna lose all your money. Your neighbor's gonna lose their money. Their kids are gonna lose their money. Like everyone's gonna lose.
But you know what? As a lawyer, let me say this because I probably know where it's going. The good lawyers. That's what it's supposed to be.
Yeah, this is what you guys all say. They're in cahoots. This is how they bill. So don't listen to them.
This is CYA.
Oh my gosh, did you and Nick talk before I got on here?
No, but it's just how it works.
He has said that. Do you know how many times I've argued with him over the PPM? I'm like, can't you just say it nicer? He's like, no, because if they're scared now, they shouldn't invest. He said, and that's exactly what he says. This isn't your marketing materials. And it's like, but it could be if you wrote it nicer. And so what I tell people, like, so I do a lot of training in my Facebook community, and we were talking about raising capital and communicating this to investors and, you know, telling them what to expect from the process. And I'm like, listen, when all else fails, you just blame Nick and be like, my attorneys are making us do this, because it's true. Like, he will argue with me to the death, and I'm paying him to argue with me, so it's even worse. And so that's where Blame Nick came about. And so now everybody that's in the community, they're like,
blame Nick.
Blame Nick. Every time, you'll see this when he's on stage. If there are people there from the Mastering Multifamily community, they're going to be like, blame Nick. Every stage I'm on, when I mention Nick, I hear it from the audience. I'm like, oh, my people are here.
It's trending pretty high.
I mean, have you ever known an attorney to be like branded with a whole hashtag?
I mean, I feel bad for him.
Do you?
Because he did his job.
I know.
You know what I mean?
It's annoying still.
How about thank Nick? Can we do hashtag thank Nick?
No,
okay.
This is not the move.
I think this is actually going to start a hashtag blame Matt too.
Oh, I like it. I like it. See?
Let's not let that catch on.
He's like, next question, next question.
All right, no more questions, Tristan. All right, what do you got?
And you're canceling me from the Alt Asset Summit too.
We would never. We would never.
Blame Matt is going to be trending by then.
No.
Let's make it a thing, guys.
Dude, that's a different Matt with 2 T's.
One person did put 2 T's, but somebody already corrected them.
See?
All right, let's jump to questions then. We'll kind of jump around, so if anyone sees their question get answered before somebody else, I'll get to it.
Blame Tristan.
Blame Tristan. The new hashtag.
How would you invest in multifamily utilizing self-directed accounts with multiple people? Do you need to set up an LLC together?
Ooh, okay, I'll ask her that.
Yeah, you can answer that.
No, you don't need an LLC, because that's the thing, is the syndication is either going to be an LLC or a limited partnership itself. So your IRA is going to invest, and let's say you got a spouse's IRA that's going to invest in the same syndication. You're each just going to buy your own separate units, just like the 100 other people that are invested in this deal. You don't need an LLC. Now, we do have clients that'll do smaller multifamily deals or commercial deals, and they'll pool 5 or 6 or 7 people together between IRAs and individuals, where we're going to use what we call a multi-member IRA LLC. But skip the LLC costs. That'll just cause you more money.
Unnecessary.
Yeah, you have an LLC, right? You're doing LLCs?
We do LLCs. Okay. I think the only potential benefit, depending on who you're investing with, is, let's say that there's a fee discount or some kind of better terms you get if you invest $1 million, right?
There you go. Great point.
Maybe then you create an LLC that you have like 4 or 5 friends get together and invest $250,000 or $200,000 each into it. That might be the use case for it. But if you can skip putting together another entity, because you have compliance and you have to file taxes and you have to register.
And my law firm sets up these LLCs. So I'd be like, set it up. You need it. You need this.
But that wouldn't be valuable for you.
Yeah, you could skip it. Now, one other thing that's important to note on this is, because like your deal and other people might be looking at people that do a 506C deal, is they have to be accredited investors. So anyone who, if you do that LLC structure, let's say, because you're trying to pool a little bit more money to get better terms,
Yep.
because there's like a minimum for better terms. Let's say
all have to be
exactly.
accredited.
Everybody's got to
Yes.
be accredited, so
Yes.
you don't get to like pick someone else's money into the deal
No.
that couldn't have invested it by
No.
themselves individually.
I get that question all the time. People are like, well, I want my kid to invest. I'm like, great, are they accredited? I already know they're like 12. And they're like,
Well, they're a
no.
YouTuber. They're balling.
I mean, they could be, I
Yeah,
guess.
they open
the crypto
open
kid-
presents, you know,
Yeah.
on YouTube, and
You know, that's the highest paid YouTube channel.
the kid that opens
The kid that
presents and
opens-
plays with toys.
Yeah, like I would do that for half of the money. I'm just saying. He makes like $9 million a year or something.
I know, and here you are, you know, doing
Slumming it with the multifamily
slumming
people.
it,
I
you
know.
All right, what else we got, Tristan?
All right, this one's from Steph, Matt. All right.
right.
This is lots of single-family residents are becoming multifamily via SB9 and the use of ADUs here in California.
Mm-hmm.
Does this change the loan process for single-family versus multifamily? How does that work with the self-directed IRA if purchased as a single-family home and converted to multifamily? Thanks, Steph.
I can
Go for it,
I
yeah.
can I
I'm
can
gonna-
speak to this.
yeah, go
Now
for it.
I'm gonna give like a very attorney answer and say it depends, which is the other hashtag for attorneys.
You know, I just feel like we've been friends for so long, because that's like the first thing I learned in my first year of law school.
Yeah.
I learned,
Always say it depends.
don't
no
give an
matter what.
answer.
Yeah.
Say it depends.
Hedge. You gotta
If you
hedge.
get called on in class and you try to give the answer, you will never be right.
Yeah.
The
no.
professor is, even if you nail it,
Yeah.
they will say, actually, did you think
It
of this?
depends.
What if this? And what if
Yeah.
that? So
Yeah, so it depends is really the answer. And what it's going to depend on really is what your lender uses to vet the deal and to underwrite the deal. Because some lenders are going to look at it and say, no, this is a single family property because it's zoned single family,
Yeah.
even with the ADU. Others are going to say, like, no, we can treat this as a business, especially if it's seasoned for a couple of years. They may treat it as like more of a commercial loan process, but these are going to be generally smaller loans than large multifamily, right? And so
Yeah.
it's going to depend on what your lender is going to look at when they're underwriting the deal. If they're treating it like a single family home, they're probably going to be looking at you as an investor. If they're willing to treat it as a commercial loan under their commercial umbrella, then they're going to look at the NOI of the asset, what the business plan is, and then they'll look to you as maybe the guarantor of the loan.
And I think here too, if Steph was talking about using an IRA for this deal, right, is you'll want to use a non-recourse lender anyways.
Yes.
And these are all banks that they're underwriting them, and these are smaller banks that are underwriting and holding these loans themselves.
Portfolios.
So these are portfolio loans. So those banks are going to be pretty flexible on this. But I think it's going to go back to the same thing that you were talking about. Is they want to see kind of like, well, what type of income can this generate?
Yes.
They're going to be very objective in terms of like what's the rent roll history. These are like, this is like a debt service coverage ratio type loan. That's what these
That's a great
non-recourse
example.
lenders are doing.
Yeah.
That's all they care
And
about.
I think too the other thing, and you tell me about this because I know enough to be dangerous, but the other thing when you're buying single family that you need to really be careful of is like the arm's length for the single family with the self-directed, right?
Yeah, you can't guarantee the loan. And so like there's certain banks, like we probably have like 6 or 7 banks on our website that'll lend to people buying real estate with an IRA
IRAs.
where they don't make you guarantee it. And those are all portfolio type loans.
Right.
These are smaller banks that just have kind of a niche in this area. You know, and you can't work on the property, you know, you can't put on the tool belt and go do the rehab.
Yes, the vendors.
You got to be passive to it.
That, and then also you can't invest, is it with parents and up
Right.
and down your
Well,
lineage?
you can like co-invest with them,
But you can't
you can't buy and sell between them.
between them. Okay,
Yeah.
so that's another arm's length
Yeah,
transaction.
so like if it's like, yeah, my mom wants to sell her house and I want to buy it with my IRA and rent it back to her. No, you can't do that. Like, your IRA can't transact with certain family.
So that's why you need someone who knows what they're doing, because that's not going to be a fun conversation.
Yeah, we have like 10 podcast episodes on those types of
There you go.
rules. And I tell people, so if you're new to self-directing, by the way, and you're new here, welcome, by the way.
Welcome,
people from
all the way in.
Veena's community, you might be a little newer to it. But we have Directed IRA podcasts and other webinars where we get into all these rules about what you can and can't do. And self-directing takes a little bit, there's a little learning curve. It's not like rocket science.
No.
I tell people it's like playing a board game. Like, you just need to play it once or twice with someone, or you read the rule book, and it's the same damn thing over and over.
You know what I do instead? I just rely on people that know this instead, and I'm like, I got you, Matt.
Or you
what's
can do
the
that.
answer to this?
Or
That's
you can
the
do
way
that.
better move, trust me.
But you know what? The engineer clients, the doctors,
Yeah,
the
they're
pilots.
analytical.
They're
Yeah.
like, I need to know everything.
Yeah.
And they'll ask me questions like, what about this? I'm like, are you going to do that? No, I'm just curious.
Yeah. But you literally wrote the book on it.
I wrote, thank you for the plug there. I wrote the book on it. I was just going to say, wouldn't it be nice if someone like wrote a book on this, like did all the rules and took like the 10,000 hours to figure it out.
If only.
And, you know, had their clients pay them for years of research to find the answers to this. That's what my book is.
If only someone did that.
Self Directed IRA Handbook. It's only $20. It's on my website or Amazon. I think Tristan's going to drop it into the chat.
Love it. Yeah, it'll be well worth it.
It's on my site too, of course. Yeah.
There you go.
There you go. Thank you for the plug. Okay, I got another question for you, Tristan. If you want to get ready for any other fire round questions, maybe. I guess what's next for you? I mean, you're going to hit $1 billion. Like, where do you want your stuff to go? Are you going to do a Reg A offering ever? Are you down? Are you interested in that or no?
You know, we've talked about it a lot.
The Bob Marley offering, the Reg A offering.
It's hard because we've done so well with 506C, and I'm so processes and systems oriented that I'm like, it's not broke.
Yeah.
Should we really fix it?
Well, and one thing, so Reg A, for those that may not know, is basically another way of raising capital. There's someone that's raising a lot of money like you may consider, like Grant Cardone's got a Reg A.
Yes.
Neighborhood Ventures, who will be at the Alt Asset Summit, has a Reg A offering. They're here in town. But it allows you to kind of advertise, but take people who are unaccredited
investors. Yeah, the challenge that I have with that in our business model is we would really need to be in more of a fund structure or a blind asset structure because it takes so long to set it up.
Yeah.
And they're so expensive to set up that it's like, you really want to use them if you're going to go through the trouble of setting it up. So we just haven't, because we haven't really needed to. The 506C
Are your deals they're always like property specific?
Yeah.
Every offering you have is like you're in this.
We did have a $100 million equity fund that we've now closed as of 2 months ago. So we did have a multi-asset fund that has, I think it's like 4 or 5 assets in that fund. But you know, my investors just really like being able to say like, yes, I like this asset. No, I don't like that. And so we're more reactionary to our investors' demands and what their needs are.
Don't give me the blend of everything. If they're like, I know you're doing a deal in Arizona and I love that market myself, but I'm going to pass on your one in Georgia because I don't want
to file taxes in Georgia. Okay, cool. No problem. Okay. And so that's why, or some of our investors have said like, oh, I'm overexposed in Georgia, so I really want to be in anywhere that's not Georgia. So, you know, the different investors have different needs. Yeah. I will say the blind fund or semi-blind fund structure is a great structure for a lot of reasons. You know, especially if you're a smaller investor, maybe you're putting in like $100,000 and you want it to be diverse across 3, 4, 5 assets. It's very tough to do that in a direct asset with $100K. So that might be one of the benefits. The other benefit would be, you know, you are diversified across multiple assets, but it really depends on who you are as an investor, what you like to do. For us, most of my investors prefer, yes, I want that deal. Yes, I mean, ironically, they say yes to pretty much every deal I do. So I don't know what the difference is, but you know, they appreciate being able to say yes or no to that deal.
Yeah. Okay. So just go to 10 billion next.
Sure. Why not?
And just keep doing what you're doing.
Why not? It's just one more zero.
It's easy. Just talking about zeros here.
What I think is next is, and I've actually already started kind of stepping into this. So I've checked what feels like a big accomplishment, right? Next quarter, I feel excited about having crossed that $1 billion mark. So now I'm really looking for impact. Like that's my goal. That's kind of the central focus. And so I started the Mastering Multifamily with Veena Jetti Facebook community. I do a lot of coaching in there. I do a lot of live free education in there because now I'm at a point where I feel like I've done enough to feel comfortable telling someone else what they can and shouldn't do or should do, right? Before that, I was like, I don't know what I'm doing. I'm still figuring it out too, right? But now I feel like I got this. Yeah. And so if I can save somebody the heartache of the trials and tribulations I had to go through when I first started, and if I can make someone shorten their learning curve by 5 years or 10 years, I want to do that because I want to see more people getting into this space because it's been life-changing for me.
Yeah. That's awesome. What's your community again? Mastering Multifamily?
With Veena Jetti.
With Veena Jetti. Is there another Mastering Multifamily?
I would have to guess that there probably is.
Okay.
Yeah.
That's the one with Veena Jetti.
It's
That's
the one with Veena
legit
Jetti.
one.
Yeah,
Okay.
you'll know when you find it.
Okay. All right. Okay. I did join it and I haven't
You did?
dabbled in it yet. I joined.
Oh, good.
Yeah.
Now I can tag you in things.
Yeah.
I didn't know you joined it.
Yeah, I joined it. I'm just not big on Facebook, so I got to just get into it.
Tisk.
I know. I've heard the Facebook groups are where it's at, though.
It's so good. The groups are great because you can build community there.
Yeah.
You can't do that on Instagram because the
Yeah.
way it's formatted, the algorithm is not set up for that. What you can do in Facebook is you can create conversations. Like people will post things about things they're having trouble with or what they're learning or something new they found or a deal they have or an investment they want to make. And then I don't have to be the only one weighing in. There's so many people that are so knowledgeable and quite frankly that know more than me in a lot of different arenas that can weigh in.
Yeah, you're like crowdsourcing all this information.
Absolutely.
It's like your own artificial intelligence right there. It's just like regular people intelligence that happen to know stuff.
Right, and they know stuff and they're smart, so I like the regular people intelligence. And
I didn't mean that in a negative way. I just mean it's like real people who know the answer to random questions.
Well, because like AI is great, but there are some limitations. Like if you ask them what to do when A or B happens in a multifamily complex, they're gonna be like, "I'm sorry, I'm not equipped to answer that." Right? Like go ask ChatGPT something like that. And so, yeah, it's crowdsourcing experience, real intelligence, real people, but it's building those relationships. Because now what's happening is people are partnering in the group. They're doing deals together. They're buying and selling from each other, which is really cool.
Yeah.
And, you know, like I'm investing into deals that I'm finding within the community as a passive investor. So it's great for my deal flow, too.
Yeah, that's cool. You can find stuff, too. Well, that's cool. It's like like-minded people, too.
Yes.
Trying to level up their own game.
That's the biggest win.
Yeah.
Actually, that's the biggest secret for anybody is be around people who think like you because it will be like pouring rocket fuel on a spark, right? Because they already know the things you maybe don't know yet. Yeah. And successful people don't gatekeep.
Yeah. Or they're trying to figure out with you at the same time,
or that.
you know,
or
and
they
that's
learn
very
something
encouraging.
new.
And and you can see other people kind of succeed and also learn from other people that are, you know, everybody's going to make mistakes and have a bad deal. And I like on the due diligence side you talking about that. But that's a lot about some of these communities, and I've been meaning to get into yours, but even just here on our webinars and stuff, and we've had some clients come on and talk about their journey in self-directing, and it's like you can learn from people's mistakes, and it's just it's just to hear it like raw from someone like a real person, you know, rather than reading about it or something. It's just very different.
Well, it's why we like Yelp, right, or Google reviews, because it's real people being raw about their experiences, and I think that, and it's a safe space to do that, right? Because entrepreneurship's a little lonely, and you know, especially when you're in the middle of a deal, right? You're not going to go to your investors and be like, oh, this is really tough. No one wants to invest in this deal. Can you invest in it? Like, who wants to invest in that deal, right?
I got my money back.
right, exactly. And so, you know, but there are naturally some hurdles you have to get over when you're first starting. And, you know, I had to overcome those too. And it's easy for me to talk about them now because, you know, the PTSD is long gone from those deals. But, you know, it's hard when you don't have anywhere to go to ask those questions, right? And so I think that's the other thing about community.
Yeah, that's awesome. It's hard to get someone that's done it and done what you've done on your level to, like, be leading that community. That's very cool.
It's a labor of love. That's why.
Yeah.
It's because
but it's your impact. It's the
goal has changed. Yeah, the goal has changed. You know, I also, one of my big platforms is seeing women investing more, and you know, I'm very proud to say that this community that we're building together is very diverse. There's a lot of minorities, there's a lot of women, so we're now seeing more representation at like the top levels, which is really exciting for me. Cool. And I've seen an uptick in women investors. And so I have women LPs that come into my deals now, which more so than ever before. And I'm so excited about that.
Yeah, I think a lot of the statistics, women are catching back up, you know. It's going to take a while, but women are catching up in terms of financial power and investable dollars.
But only 31% of investors are women. Isn't that sad?
Yeah, that is sad.
It's not enough.
I mean, I got 3 daughters, 2 stepdaughters.
Yeah,
you know.
you're a house full of girls. I'm a house full of girls.
Yeah, you got your twins.
Yeah, so. we need more diversity.
Yeah, we got to make it ready.
Diversity is a strength.
Okay, I like that. So. All right, Tristan, what else we got? We got maybe 2 questions we'll finish in and then call it.
Yes, the boss lady movement is striving. We love it. All right, let's go back up here. So for anyone that joined late, this will be recorded. We will post it on our YouTube. It will go up in the next couple days.
And at directedira.com/webinar.
Yep, I went ahead and dropped those links in there for everyone. Lorraine, I did see... You noted about the non-recourse lenders. I did drop that in. So there is a list of non-recourse lenders that we work with. So if you want to click on that link, it'll show you a list. All right, back to questions. Does directed IRA help new investors with the process of transferring conventional 401ks from an existing employee accounts to directed IRA's new account?
Heck yes, we do. We got a team for that makes it easy for you.
Amazing.
So there's really 3 steps if you want to self-direct your IRA. Let's say you've got the old employer 401k. That was the example here. And you want to invest in a real estate deal. It doesn't matter what it is, or you private equity fund, whatever. It's 3 steps. 1, you got to open the account with us, which you can go to directedira.com and schedule an appointment with one of our account reps. It's free. We help you open the account. That's step 1. Step 2, you got to fund the account. Now, if you have an old employer 401k, all we're going to do is there's a form that your old employer is going to have that's going to say,
forms with these IRA companies.
It's got to be in writing and signed, and then you authorize that money to come over to your IRA with us. Now, there's no tax or penalty, okay? You have an IRA account with us, there's no penalty or tax. You're just moving the money from Vanguard, let's say, over to directed IRA. And then step 3, once that money's here, and we have a team that helps you do that, by the way. We're not leaving you on your own to go figure it out. Step 3 is then you authorize the investment. So you say, I want to invest in XYZ company or ABC fund or buy the property at 123 Green Street. And so there's an authorization of investment form you submit with us that then invests
Another
it.
form.
Yeah.
Just another form, that's all.
Because, see, this is your money,
I mean,
we're not like your financial advisor where we get your money and we just invest it and you're like, what did I get? And they're like, we put you in a target date fund that says, when you want to retire when you're 60 and you're 40 years old, that means you've got 20 years of risk. And why don't we put it in, are you moderate risk, mild risk, high risk? It's like that BS stuff.
Yeah.
We don't do that.
You don't do that.
So we want to know what you want invested in. I don't know. I've had clients buy Mexican soccer teams with their IRA, livestock. Yeah, like we've had clients invest in
crypto. You can buy
like companies
everything.
before they hit IPO. We've had a bunch of clients in a company that just hit just went public. I mean, literally, it's everything you could think of.
Love that.
We have clients.
I love that. It's
so,
self-directed.
Yeah.
So you direct it. It's in the name.
Yeah. Now we do make it easy, but you got to approve it. So you're like captain of the ship here, but we're like your first mate, second mate too.
Oh, I have a question.
Yeah.
Okay, I can't believe I'm just thinking of this right now. So my kids have Roth IRAs.
Yes, love that.
And we hold them at like Schwab or something,
okay.
or Fidelity. I can't remember where. One of those two.
Yep.
Can they self-direct an IRA?
Absolutely. We call it a kids Roth. It's not. That's not Kid Rock. That's Kids
Kid
Roth.
Rock, not Kid Rock. Okay, so
different.
you're not gonna like bust out in like some kind of song and dance.
No,
All right.
But I'm a fan. It's nothing against Kid Rock, but the Kids Roth. So yeah, we've had clients. Now they have to be able to do a deal, because they might have 10 grand in it. I don't know how much contributions they have in it yet. Well, and so
my kids are young, so give me some time.
Yeah, but I mean, we have clients. I have a lot of deal maker real estate clients who put their kids' Roths on, like they'll put them in a wholesale deal, an option deal, and by the time this kid's 20, they got this ridiculously large Roth IRA. I had one client did a Coverdell savings account. His kid ended up going to Georgetown. And he would put the kid's Coverdell savings account in little real estate deals where he'd get little options. He could option it and make some money. And it covered this kid's Georgetown tuition. I remember the checks, we'd see him go out. And I'm like, man, that school's expensive. It's a good thing this guy knows how to make money.
For real.
But it was totally in a tax-free way.
Amazing. I'm totally going to transfer my kids' IRA. I can't believe I didn't think of this.
Yeah. And I think it's great for your kids is like, get the money in, contribute it. And even if you're at TD Ameritrade or Fidelity, but once you find a deal where you're like, all right, I could do a little deal with my kids, $6,000, and I could double it or like 50 grand.
I could flip that money so fast in non-multifamily, and then I get them to accredited status, and then they can invest in my deals.
That's true. Now, it's not earned income because it's in their Roth, so it's not taxable.
No.
So I don't know if it'd be
They need $1 million of net worth.
Okay, there you go. Get them up to $1 million.
Yeah. Why not?
I just love your thinking. I like that. Okay.
Right?
I'm.
That's the move.
That's the move. Okay, that's the move. All right. One final question, Tristan.
One final question. All right. How bad do you want it? Do you want the U word or are you looking away from the U word?
I don't care. You pick one.
All right. All right. We're going to go ahead and ask it.
I don't know.
Can you tell us how UDFI
UDFI
tax may increase the taxes you pay when investing
let me answer
IRA
this.
funds to buy rental properties?
Okay. So there is a tax would apply to real estate, even if you're investing in a multifamily field called they're called the UBIT, unrelated business income tax, but the version of it is called UDFI. It's a whole chapter in my book. We have a separate webinar on this, podcast episodes, a lot of content on it. Let me explain how it works, because even I was doing a live yesterday with some CPAs on this because it's so misunderstood.
Yeah.
Okay, let me just talk about it in terms of you buying a property yourself, then I'll make the analogy to the fund, because if you don't know what I'm talking about yet, it takes a second. Okay, let's say you're going to buy a property for $100,000 and you have $40,000 in your IRA. So you go to the bank and the bank lends you $60,000 so you can buy the $100,000 property. Okay. Now the bank looks at that property and they're like, 60% of that is not IRA money. You had $40,000 and you made a $100,000 investment. So 60% of this deal is debt. We're not going to give you the tax-free treatment on the debt because it wasn't retirement account money. It'd be the same as if Veena and I were doing a deal. We bought for $100,000. I used my IRA with 40, and you used your personal funds for 60. The IRS is going to be like, okay, you bought that property for 100. Well, we're going to tax Veena's money because that wasn't IRA money. But the 40% going to Matt's IRA, that's not taxable. So it's a similar thing where the Congress and the law basically said, we'll let you buy more assets with your IRA using debt, but we're going to make you pay tax on the profits that come from the debt side of things. Okay, so let's say you held that property for a couple years, you sold it, had a $20,000 gain, $10,000 of expenses. So at the end of the day, you really made $10,000, okay, net. The IRS looks at that and they say, okay, $10,000 net. Well, 60% of that was non-retirement plan dollars, so we're going to tax 60% of the profits of $10,000, which is $6,000.
Yeah.
Well, you get capital gains rate on that, by the way, which is 20% max rate. 20% of $6,000 is $1,200.
Yeah.
Okay, so at the end of the day, instead of buying a $40,000 asset or $40,000 worth of stock or $40,000 of a mutual fund, I was able to buy a $100,000 property, and I increased my rate of return, and I paid, at the end of the day, 12% tax on the total thing. That's better than you're ever going to do personally, okay? And so don't get too confused on it. Now, it works the same in a syndication. If I was in Veena's fund and my IRA was in there and I get a K1, and I don't know how your K1s flow out, but a lot of times there's a loss on it year to year.
Yes.
Like you guys are depreciating the heck out of stuff and taking all these tax write-offs, and I might be cash flowing, but there's a negative on my K1.
Correct. Yeah, year one especially.
Yeah.
You're going to get like negative maybe 50%. So I'm going to give you negative 50,000 year one.
And that loss that I'm going to carry forward on the future years. And so really I'm not worried about this year to year. Even if the property's cash flowing and I'm getting money in my retirement account. But you sell the property in 5-10 years and you still have debt. Now I've got to take the gain I got based on what the debt at the time. So let's say at that time you sell, there's 50% of the property's leveraged with debt. Now, and let's say I got a $100,000 gain. Okay, now 50% of that is debt because that's what's left, the current leverage ratio. So now I got to take 50% of 100,000, 50 grand, and I'm going to still apply capital gains rate actually of 20%. That's what you get to do on UDFI. So what is that? $10,000. So you need to know it, and I want you to be able to make sure you can calculate it and know about it for IRAs, but look at total return at the end of the day. That's what I want you to focus on.
But then can't the depreciation that I give you offset the
Absolutely.
UBIT?
Yeah.
Okay.
So I'll use that to offset it. But like if your property kicks butt, and I'm getting a huge gain, a lot of times the depreciation is not going to be enough. And so we do have clients that have it hit. And I'll be honest, I mean, I've done a lot of these 990Ts. The clients that have had big tax bills on this have made a lot of money.
They made a lot of money, yeah.
You
can't be that mad.
Yeah, they made a lot of money. So it's like, they're not complaining.
Yeah.
So just know about it. Now, 401ks, employer-sponsored plans are actually exempt from this. So like solo 401ks and stuff like that.
Do you guys do that here?
Okay. Yeah, we do the solo 401ks.
Amazing.
Yeah, absolutely. There's a chapter in my book on it,
Shocking.
Shameless plug.
Shocking that you thought of putting a whole chapter on that.
I mean, it's like 40 pages too, so it's good.
I love it.
Yeah.
I have your book. I just haven't read it yet because it's still on my list.
That's all right. When you're like can't sleep at night and you're like,
this
tossing and turning, just crack that baby open.
Nothing puts you to sleep more than taxes.
I'm just kidding. It's a great book, actually. I've had somebody. I was on my social. Someone's like, I got the Bible of self-directed IRAs. I've had so many people refer to it as the Bible.
That's a big deal. It's a big deal.
I guess so. It makes me feel a little weird.
Pat yourself on the back.
Yeah, the Bible. That's
exciting.
Okay. All right. Well, Thanks everybody for being on.
Thank you.
Thanks Veena for spending your time with
Thank
us.
you. Thank you for having me.
We're going to get this recording up. And remember, if you liked hearing Veena, she's going to be at the Alt Asset Summit. Get over to altassetsummit.com. Yeah,
we're going to take pictures, right?
Absolutely.
My social media
team. Yeah, you'll be at the VIP dinner.
Yes, I'm going to be at the
VIP
VIP
dinner. So get the VIP ticket. There's still some of those left.
Yeah, you know, I always tell people, if they're going to take the time and the energy and the effort to come to a conference and not come for the VIP, you're doing it wrong.
I agree. Yeah.
Like, just do it. It will be worth it. And if you can't, how much is a VIP ticket?
I don't even
like
know.
a few $100?
It's not that much. Yeah, it's like $400, $399.
Like a few $100.
Yeah.
And if
could
you
be $499. Not that much. It's
under $1,000.
Yeah,
if you can't figure out how to make that money back by being in that VIP room, then that's on you, really.
Yeah. And I have one client who's like, my lifestyle is always VIP. I mean, why would I not do VIP
Exactly.
ticket?
Exactly.
That's what I'm going for in
exactly.
life. Always VIP.
Yeah, I agree.
It's good.
It's where you want to be. It's the room you want to be in. So.
All right. Well, thanks, everyone. The recording will be up. Make sure you share this with any of your friends.
Yes.
Get over to directira.com/webinar to catch this. We'll also put the slides up on the page. And make sure you're signed up for the newsletter so you get announcements of our upcoming webinars and all the great things going on here at Directed IRA. Thanks again, Veena, for being here.
Thank you. Appreciate you. Bye, guys.
All right. Thanks, everyone.